In our last session, we started to have a look at the idea of double entry bookkeeping in terms of looking at the accounting equation and establishing the dual effect of each transaction and the business entity principle. We also saw in the last session just before this one how to record that dual effect in our ledger accounts. Okay, so in our T accounts as sometimes referred to. We also learnt at that point what is a debit and what is a credit. What I would like to suggest at this point, if you have your notes from the previous recording, would you be able to have them to hand just so you can have in front of you that dead click mnemonic that we looked at in our previous session? That will help us with our example, which we're going to have a look at in this session, and then we're going to answer this example in subsequent sessions thereafter. The idea of this example is to be able to take transactions, record the dual effect and the double entry, popping it into our ledger accounts in order for us to prepare our financial statements at the end of the period. So that would be our statement of comprehensive income and our statement of financial position. What we're going to do is have an introduction to this example in this first session. So let's have a look at this example. What we have here is George, and George commences business on the 1st of April 2009. The following transactions take place in his first 2 weeks of trading. So we can see then that we have 8 transactions for George in his first 2 weeks of trading, and we've got them listed out as you can see in your notes. Let's have a look at the first transaction. On the 1st of April 2009, he invests $50,000 into the business. Now we've seen a transaction similar to this in earlier sessions. What we need to do is be able to record the dual effect of this transaction and also to be able to record the debit and the credit entry. We're not going to do that right now. We're going to read through the rest of the example, but whilst I'm going through these transactions, have a think about that dual effect and see if you can think about that yourself. Our next transaction. On the 2nd of April 2009, he purchases $5,000 worth of goods on credit. So George is purchasing goods from another supplier and he's promising to pay for those goods at a later date. That's what we mean by purchasing on credit. Okay? We've been given an amount of time before we actually need to settle the bill. Okay? So the $5,000 that we would owe to our supplier. Our third transaction. On the 3rd of April 2009, he sells half of that inventory for $6,000 cash. So what we need to think about here is recording the sale of goods, the sale of inventory. Now remember, when we make a sale, we're going to be selling it for some sort of profit. And we can clearly see that we've made a profit here because he sold half of the inventory for $6,000, a lot more than when he purchased the full amount of inventory in the previous transaction for only $5,000. So we've made a sale, and in return for selling those goods, we're going to receive cash in return. The 4th of April then. The 4th of April 2009, he issues a cheque to pay for the goods that he received on credit. So now he is settling the amount that he owes to his supplier. He owed them $5,000. He is now settling that debt. He is settling the $5,000 by writing a cheque and giving it to his supplier. He's paying for those goods now. So we would need to think about the dual effect for paying for those goods that he purchased earlier on the 2nd of April. On the 5th of April, he pays his rent for April for $450 by cheque. So again, George has wrote a cheque and given it to the company that he rents his property from, we assume, and he's paying that rent by cheque. Okay, so we need to think about what the dual effect would be for paying for that rent. On the 6th of April 2009 then, he sells his remaining inventory for $6,000 on credit. So this time he's selling the remaining goods just like he did in the previous transactions, but this time he's not receiving cash in return straight away. He's making the sale, and in return he's letting the customer pay us later. So George is not receiving the cash now. He's going to let the customer pay at a later date. All right, so that's what we mean by selling on credit. On the 7th of April 2009, he purchases goods on credit for $7,000. So again, he's made a purchase on credit, so George is promising to pay that supplier at a later date for some more goods, so some more inventory. Our final transaction then, on the 8th of April 2009, he purchased a delivery van for $7,000 cash. Okay, so he's purchasing a delivery van, a motor vehicle, and he's paying cash in return for receiving that motor vehicle asset. So there's our 8 transactions in those 2 weeks for George. We need to be able to record those transactions. So now let's have a look at the requirements for this question. The requirements. For the first 2 weeks of trading, prepare the journal entries for George, and the journal essentially records that dual effect we were talking about. And by recording that dual effect, we can then record the debit and the credit entry as well. Our second requirement is to prepare the ledger accounts. Okay, so remember in our previous session we saw the ledger accounts, or T accounts that I referred to, and that's going to be where we record the journal entries, where we physically update the ledger accounts for that dual effect. Our third requirement will then be to prepare what is known as the trial balance. Now, for now, what we will refer to the trial balance as is that it's just a list of our ledger account balances. Okay, so it is a list of ledger balances. And we'll look into that in a bit more detail when we come to prepare it later on. From our trial balance then, requirements 4 and 5. Requirement 4 is that we should prepare a statement of comprehensive income for the 2 weeks ended the 14th of April 2009. And then we shall prepare a statement of financial position as at the 14th of April 2009. So at the end of those 2 weeks. So how we're going to approach this then is for each subsequent requirement we're going to have a separate recording for it. So in our next recording we're going to start answering this question by preparing the journal entries.